Hello everyone and welcome to this week's Hoxton Wealth Market Update. This past week has been a powerful reminder of why we invest with discipline and why we encourage you to stay the course even when the news feels overwhelming. Let's begin with what dominated the headlines. Last weekend, the US launched targeted strikes on key Iranian military sites. That was quickly followed by a retaliatory missile attack from Iran on a US airbase in Qatar. It was a moment of real tension, and understandably, many investors feared the worst. At the start of the week, it really felt like it was going to be a very bleak week for investors. But then something remarkable happened. Just a few days later, we saw a ceasefire agreed between Iran and Israel. The situation de-escalated far more quickly than most people had expected. And here's the important part. Global markets remained composed the entire time. They didn't drop like a stone, like many expected. They remained strong. Now, that's not something we say lightly. Historically, military escalation in the Middle East has sent markets tumbling. But this time, investors largely looked through the noise. Why? Because they understand something we talk about often. Short-term volatility, even when driven by serious geopolitical events, rarely changes the long-term fundamentals of global investing. Instead of panic, we saw strength. In the US, the S&P 500 rose 3.44% for the week. The Nasdaq surged over 4%. Even the Dow Jones and Russell 2000, indices that tend to lag, gained more than 2.5%. These are big moves in a short space of time. Part of this momentum came from calming geopolitical headlines, but the other driver was a shift in tone from the US Federal Reserve. For the first time in months, the Fed hinted that rate hikes may be behind us, and that rate cuts could be on the table later this year. That's encouraging news for both equity and bond markets. Let's turn to the economic picture. Inflation nudged higher in May, but consumer expectations around future inflation have expected to fall. That's a subtle but important shift. When people expect prices to stabilise, they're more likely to spend confidently and businesses can plan accordingly. Business activity slowed slightly, but not dramatically. Manufacturing picked up for the first time since February, and orders for durable goods, think things like machinery, vehicles and equipment, surged. That suggests companies are still investing, still growing and still confident. One area still facing headwinds is housing. Existing home sales have ticked up a little, but new home sales dropped again. Mortgage rates remain elevated, and that continues to weigh on demand. But this isn't unexpected. Housing markets tend to lag behind broader economic shifts. As interest rates begin to ease, we'd expect a more meaningful recovery. Now let's talk about bonds. This past week saw bond yields fall across the board. Thanks to weaker economic data and the softer messaging from the Fed, as a result, bond prices rose. And the Bloomberg US Aggregate Bond Index posted a solid gain. For those of you invested in our moderate or cautious strategies, this is particularly meaningful. Bonds may not deliver the same excitement as equities, but they play a really crucial role in smoothing out volatility and providing steady income. And short-dated bonds? They've been especially helpful. With low sensitivity to interest rate swings and attractive yields, they've given our portfolios flexibility, both in terms of income generating and managing near-term cash flow needs that you might have. Remember, a well-diversified portfolio isn't about chasing what's hot. It's about combining assets that behave differently in different environments. This week, bonds and equities both pulled their weight, and that's the power of balance. Let's now take a look at what's happening around the globe. In Europe, we saw modest but welcome gains. The Euro Stoxx 600 rose 1.32%, while Germany's DAX jumped nearly 3% on hopes of increased government support. Inflation came in a bit higher in France and Spain, largely driven by rising fuel and services cost. But overall sentiment is improving. In the UK, the Bank of England remains cautious. Governor Andrew Bailey has indicated that rate cuts may be on the horizon, but they'll be slow and measured. This is good news. Rushing to cut rates can cause inflation to spike again, and that's something no investor wants. Meanwhile, in Asia, Japan's Nikkei 225 had a strong week, climbing 4.55%. The Bank of Japan continues to be careful with its policy decisions, choosing to wait for clearer inflation data before making any major moves. That patient approach has given Japanese equities and bonds room to grow. In China, we saw a meaningful step forward, the confirmation of a new trade agreement with the United States. The CSI 300 and Shanghai Composite both rose around 2%, while the Hang Seng gained over 3%. The deal isn't perfect, but it signals progress, and progress is exactly what markets want to see. So where does all of this leave us? It leaves us with a clear message. Markets are resilient. They respond not just to fear, but to clarity, to progress, and to potential. And this week, we saw all three. If you're someone who stayed invested through the noise, you're now seeing the benefit. If you've been sitting on the sidelines wondering when to re-enter, this is a reminder that markets often recover before the headlines improve. No one can time the market perfectly, but history shows that those who stay invested, who stay diversified, and who stick to a long-term plan are the ones who tend to come out ahead. At Hoxton Wealth, this is exactly why we design the portfolios the way we do. Global exposure, a blend of equities, bonds, and alternatives, tactical shifts where needed, but always with a disciplined, thoughtful framework. If you're unsure about your strategy or you'd like to review your plan, please don't hesitate to get in touch. You can either get in touch with your advisor or our client services team is always here to help. You can reach us by email at client.services@hoxtonwealth.com or on our new WhatsApp number, +44 7384 100 200. +44 7384 100 200. In closing, this week was a turning point. Not because everything is suddenly perfect, but because we saw yet again that calm and disciplined investors are rewarded in the long run. So keep going, stay invested, stay diversified, and above all, stay confident in your plan. Thanks for watching, and I'll see you next week.